The cost of capital.
Capital structure policies are put in place in an effort to maximize shareholder returns. Managers do this by maximizing cash flows and minimizing the cost of capital. The calculation of the cost of capital is important in part because it represents an important parameter in a firm's capital budgeting decisions. According to the Census Bureau, capital expenditures on property and equipment in 2010 were over $1 trillion for U.S. non-farm businesses. Without question, the cost of capital estimate was a key determinant in these spending decisions. Miscalculating the cost of capital can lead a firm to reject a potentially valuable project if the cost of capital is overestimated, or accept a project that fails to meet investors' required return if the cost of capital is underestimated. Here we look at the considerations in estimating the cost of capital. The components of the cost of capital include the required returns on equity and debt, and Figure 8.1. Benefit of debt for Six Flags and Performance Food Group. The relative weighting of equity and debt in the capital structure. Although there are different types of equity and debt, for example, preferred equity and convertible debt, we focus on common shares and straight debt. Off-balance sheet items are also a source of capital, thus we discuss their impact. The cost of equity. According to a study by Bruner, Eads, Harris, and Higgins, CAPM is the dominant measure of cost of equity. 27 They reported that 80% of corporations and advisors and 100% of textbooks use CAPM as the primary measure of the cost of equity. A more recent survey by Graham and Harvey found that 75% of corporations use some form of the CAPM to measure the cost of equity. 28 Some corporations and advisors may also use multi-factor models that consider not only market risk but also sensitivity to other factors such as firm size and book-to-market value. The return on a risky asset must provide compensation for the time value of money and a risk premium based on the asset's level of risk. The CAPM recognizes two sources of risk: systematic risk and unsystematic risk. Systematic, market, risk affects all assets in the market and reflects sensitivity to variables including GDP, inflation, interest rates, and other macroeconomic factors. Unsystematic risks are specific to a firm and reflect variables that can include layoffs, strikes, supply shortages, upper management changes, and other firm-level factors. There are two underlying assumptions of the model. Market prices are efficient, that is, they are fair and reflect all available information, and all investors hold a well-diversified portfolio, that is, they are free of unsystematic risk exposure. Since poor returns on some stocks will be offset by good returns on others, the total risk exposure of a well-diversified portfolio is due only to market risk. Accordingly, the CAPM states that investors should only be rewarded for systematic risk. This depends on the market risk premium and the firm's sensitivity to movements in the market. We examine different proxies for the risk-free rate, the market risk premium, and the measure of systematic risk, beta. Risk-free rate. Theoretically, the risk-free rate should be a default-free return that represents compensation for the pure time value of money. Textbooks often use an average of historical T-bill rates as a proxy for the risk-free rate. Firms and analysts tend to use current interest rates on long-term treasuries to match the time horizon of their investments. Bruner, Eads, Harris, and Higgins reported that 70% of firms use treasury maturities of 10 years or longer. 29 The spread between short-term and longer-term yields has averaged about 1.5% and is currently 3.21%, 30 So the choice of maturities can have a significant impact on the cost of equity estimate.